Welcome to the Consumer Finance Podcast. I'm Chris Willis, the co-leader of Troutman Pepper's Consumer Financial Services regulatory practice. And today we're going to be talking about what financial services companies will need during the upcoming Trump administration. But before we jump into that topic, let me remind you to visit and subscribe to our blogs, TroutmanPepperFinancialServices.com and ConsumerFinancialServicesLawMonitor.com. And don't forget about all the other podcasts we have. The FCRA Focus, all about credit reporting, the Crypto Exchange, about everything crypto, Unauthorized Access, which is our privacy and data security podcast, Payments Pros, which is all about the payments industry, and Moving the Metal, which is our auto finance podcast. All those are available on all popular podcast platforms. And speaking of those platforms, if you like this podcast, let us know. Leave us a review on your podcast platform of choice and let us know how we're doing. And if you enjoy reading our blogs and listening to our podcast, our handy mobile app is the best way to do it. It provides full access to both, and it's available for both iOS and Android. Just go into your app store and search for Troutman Pepper, download it, and give it a try. Now, as I said, we're going to be talking about what will be important to the financial services industry in terms of their legal needs during the upcoming Trump administration. And to talk about that with me, I have four of my colleagues. From our Consumer Financial Services group, I've got my colleagues Mark Furletti and Jesse Silverman, but we also have two special guests. From our corporate group, we have James Stevens. James is a corporate lawyer, but he specializes in financial institution corporate work, so we're very glad to have him here. And then finally, but certainly not least, we have our partner from our Regulatory Investigation Strategy and Enforcement group, also called RISE, Stephen Piepgrass. He's the practice group leader of that group, and that's the group that contains our very preeminent state attorney general practice. So gentlemen, thank you all for being here to talk to the audience about this very important topic today.
Thanks for having us.
Thanks, Chris.
So let me just set the stage here, because all of us lived through a Trump administration from 2017 to 2021. And my memory of that and the demands of the financial services industry during that time was the following. First of all, we saw less aggressive federal enforcement and less aggressive positions being taken in supervision by the federal regulators, but it was still meaningful in terms of the regulatory pressure on the industry. It didn't go to zero, but by any means. But because of the perceived more friendly environment, we had a lot of clients become interested in launching new products. We had clients interested in entering into new partnerships, especially with fintech companies. Fintech companies themselves were in a very rapid sort of growth and founding mode. But at the same time, on the regulatory front, we had states, and in particular a number of states, promising to fill what they perceived was a gap in terms of enforcement and rulemaking in terms of consumer protection. And so our practice as a law firm has to obviously be adaptable to that. So what I'm going to do is I'm going to go through each of those areas and ask our guests today to talk about what they anticipate the industry will need in the coming 4 years, and just let's take it from there. So, as I said, one of the things that there was a lot of interest in during the last Trump administration was the creation of new financial services products. Mark, would you mind talking to the audience about your experience about that during the last administration?
Sure. Thanks, Chris. I guess I view that period, Chris, as a bit of a renaissance in terms of fintech. We saw just an explosion, I think, in new products being launched. And these products were kind of across the whole credit spectrum. Now, I guess I want to note, though, that during that period, Chris, 2017 to 2020, the prime rate was very low. Of course, it was in the threes to start the Trump term. It went up to the mid fives, and then due to COVID, it came down back into the threes. But relatively speaking, the rate environment was really favorable particularly for people who have to borrow money in order to lend it out to small businesses or to consumers. Currently, the prime rate, as you know, is like in the high sevens. So, some of this kind of favorable activity, I think, may have been encouraged by or, aided significantly by the low rate, in addition to the kind of favorable regulatory environment. But, I think there's an expectation. If you look at the yield curve, it looks like the rates are likely to come down, or investors expect them to come down in the somewhat near future. So hopefully we'll kind of have another confluence of events like we had previously. So in terms of the products, we were involved in, a number of installment loan products and point of sale, and in a number of niche areas, folks who had a specialized knowledge or ability to offer financing as to very specialized products because they understood how those products were sold and how people use those. I'm sorry, this is like purchasing products or services or things. And so we just saw an explosion of different kinds of products that were designed to finance particular goods or services. Buy now, pay later, of course, was cheap among those, but we saw a number of other niches. We saw rent to own products enter the market. We helped people launch credit card programs and charge card programs. And these were all across both consumer and small businesses. We saw an explosion in bank model programs, 50 states throughout the US. I would say that I don't think this is a license to kind of do whatever you want in terms of the regulatory environment. Chris, I think just as the environment can become favorable, it can in the future become unfavorable again. And so I think folks have to be cognizant of maybe this is a good time to test things, to innovate, to try new things. But in terms of like looking at it as an opportunity to do exceptionally aggressive things and hope that there won't be any consequences, maybe there's fewer short-term consequences. I think the longer term could be problematic. So I view it as kind of a good time to both launch and test products and to innovate, as opposed to to take exceptionally aggressive legal positions and hope they don't come back at you in the future, because unfortunately they could if there's a change in administration. But we were able, of course, our expertise is providing the consumer-facing disclosures and agreements and looking at commenting on the application flows and servicing flows for consumers. And so we were able to, during this kind of quote renaissance, help folks kind of stand up all of these new programs and launch them. And a number of those were highly successful, which is great. And so we're expecting to see something like that again.
Thanks. And I'm glad you mentioned that, it's not a license to sort of do whatever you want. I think that points up the need that although it's a great time to launch new products and businesses ought to take advantage of the opportunity to do that, it still requires careful consideration of compliance issues, not just for the future, but also for the present, because the regulatory environment didn't evaporate. And we'll talk about that more later. It may have become slightly less aggressive, but that doesn't mean, as you said, that it's a license to do whatever. Jesse, do you have a perspective on this? I think during those years, you were probably in-house in the financial services industry. What's your perspective on this?
I was, and I do. I want to follow up on what Mark said and said investigations are very trailing indicators. So what you're doing now is going to actually be investigated by the future CFPB. And we do not know who that future CFPB is going to be. So I would absolutely consider going forward with all the due care that you went forward with in the past. And I absolutely agree. Like Mark called it a golden age of partnerships. And I think that's largely true. I would expect there to be a golden age again. There are still some challenging headwinds, especially in BaaS. But I think that ultimately what's going to come out is going to be better for the industry. But I also think about the CFPB in sort of a tiered approach. And we've talked about this before, but I expect there to be major changes in the types of regulations and rules that they put forward. I expect many of the current regulations to be challenged, and some of them probably won't be defended, or they won't be defended well by the new admin. But then you get down to enforcement, and under Trump, there was robust enforcement under Kraninger and Mulvaney. I would say the focus was different. They were focused more so on the traditional mortgage lenders. Anything that touched service members was very, very, like, the enforcement was stronger there. So I think that there are probably lots of people thinking about enforcement and maybe not thinking about it in the right way. Some of those companies that are on the edges where this current CFPB is pushing the boundaries of their supervisory and enforcement authority, I think they're probably going to be safer in the future. But guess what? In a zero-sum game where you've got limited resources, the CFPB is going to be redeploying those resources towards the more traditionally supervised. So they may see more action themselves if you're in those traditional spots. I wouldn't expect nothing. And then there's examinations, where examinations are the sort of the least to change administration by administration. I would absolutely expect that to continue. And frankly, that's what we saw under the last Trump admin. And I'm sure we're going to talk about this here too. But as the federal enforcement dies down, there are a number of state AGs who are ready, willing, and able to take up that cause too. So we seem to find a relatively steady state of enforcement action. The subject changes, the players change, the overall enforcement activity stays relatively harmonious, much to the chagrin of the industry.
Yeah, thanks for mentioning that, Jesse, and especially with respect to those products that are sort of positioned not to be credit, but which the current CFPB has been very active in recharacterizing as such. We may see less of that at the federal level, but that certainly is a state issue that's waiting to happen, and in fact has played out a lot in the states. And we'll be talking to Stephen about that later. So another thing I've been reading a lot in the news is that there's an expectation that M&A activity is going to pick up in the near future because of perhaps economic or other conditions. James, that's one of your areas of specialty. Would you mind talking about what you think the outlook is for M&A in the near future?
Certainly, and we agree. We think there's going to be a big uptick in the M&A space. I think that what kind of a baseline understanding that I have of the financial services industry, though, is that sort of the natural state is an insatiable desire to consolidate. Anybody, whether you're a bank or you're a non-bank financial service provider, the desire to partner through an acquisition or a merger with someone else to diversify your products, your services, your geographic markets, that is something that is sort of always on the people in the space's minds. And when you add on top of that, the need to get scale so you can get more efficient with the extraordinary costs we have, in the regulatory and the technological spend that it's expected of financial service providers. That's the way I kind of look at it. It's not like the natural state is slow and then we have periods of uptick. The natural state, in my mind, is a ramped up M&A environment. And what we've experienced over the last several years has been a sort of a down cycle. And a lot of that was not political. It was the environment we were in, the interest rate environment, the credit, concerns about the credit cycle, concerns about, whether we were going to go into some kind of recession as the interest rate environment was and inflation was addressed and things of that nature. But there's certainly a political element to it as well. And I think part of that is frankly, the regulatory matters that Mark was just talking about, is that the financial services industry has been receiving a lot of regulatory scrutiny under the current administration. And I think that nobody wants to buy sort of another person's problem. So I think that in this new environment that we're hopeful for, and what we saw in the previous Trump administration, I agree with Jesse, that certainly there's always going to be regulatory enforcement, investigations, and certainly examinations. But I think that we all agree that there's going to be less scrutiny in general. And maybe the costs will go down and the sort of unpredictable concerns that regulatory scrutiny provides is going to be less. And so that sort of sets the stage on top of some of those other more economic kind of macro factors for a lot more robust environment. And I think the last one is just generally, the market. As soon as the election results were announced, the bank stocks went up 10%. And I'm sure we've seen a similar uptick across the entire financial services industry. And I think that having a currency that's worth more and having a robust market and economic environment is another thing that encourages M&A. So we expect a lot of M&A in the coming years.
Yeah, and we, of course, James leads a team of our lawyers that are specialists in exactly that kind of M&A. But there's another thing that's one of your specialties, James, that I also wanted to ask you about, and that's bank charters. It seems like there might be the possibility under a Trump 2 administration for more people to be able to apply for and get bank charters, and maybe for the possibility of some special purpose charters. Would you mind commenting on that?
Yeah, Chris, I think you're right. And I think we did see that in the prior administration. A lot of the fintech companies, there was only a couple. So when I say a lot, I mean the handful of fintech and other non-bank financial service providers that were able to obtain a bank charter, be it a regular state or national bank charter, a Utah ILC or something else. A lot of those happened in the prior Trump administration, or all of the legwork associated with them happened during the Trump administration. And we've seen virtually sort of no new bank formation in those areas over the past several years. There's a big moat around the banking industry for those that are not currently in it. And I think that as a country, we need to have new bank formation. I think we should somehow recognize that we want people to be in the system, not out of the system, and encourage people to get into a regulated bank charter. And I think that we'll see a lot more of that during this current administration. And that goes to not only the federally regulated national banks, state banks, but I think also you'll continue to see interest in special purpose state charters. I do think that the biggest hindrance to those banks is not necessarily the proposed operators, but generally what those banks can do. So, for example, in Georgia, where I am, we have a merchant acquiring limited purpose bank charter, and the regulators are excited to talk to organizers of those banks. But that bank charter is only valuable if the card networks will allow the people to get that charter to become members. Very similar to the Wyoming charter and others around the country that really are not useful unless you can get access to the Fed master account.
Got it. Thanks very much, James. And, we talked earlier about bank fintech partnerships and the idea that it's likely that there'll be a resurgence in those during the upcoming Trump administration. And Jesse, I'd like to start with you on this. Those partnerships involve obviously product design and consumer protection issues, which we already talked a little bit about earlier, but they also involve transactional aspects. So would you mind sort of addressing kind of what the industry needs when there's a lot of that partnership activity from a transactional standpoint?
From a transactional standpoint, I'm not sure that there's a big difference between the Trump admin, the Biden admin, at least from a transactional standpoint. It's more a function of what are people comfortable doing. And I think there's just a greater comfort in being able to try out the new partnerships. And part of the challenge right now, frankly, is just there has been a lack of clear guidance on how to engage in those relationships. And so we've seen lots of problems, obviously. We have seen a host of issues, obviously with Synapse and the BaaS space. So partially it's going to be the market clearing itself out, and what's coming out the other side is going to be better, stronger than what was going in. But it's really just a function of there needs to be clearer guidance that's something more than just risk-based. And I know that there is a demand, and it's one of these demands that I think crosses party lines. I think there's a willingness to provide more guidance on how to engage in those partnerships better. And then, of course, there's one of the items that we haven't talked about at all yet, which I think is going to be seismic. And frankly, I'm not entirely sure how, but that's crypto. Right? There is a massive, massive untapped demand. And everyone who's read the newspapers has seen that they have spent a lot of money to make sure that they get access to the political process. I expect that access to present itself in wider variety of crypto products. Now, how that integrates with the traditional financial services and the banks and KYC, AML, that really is still TBD to me. But I know it's going to be very, very different.
Yeah, makes sense. James, this is another area where you practice a lot in terms of assisting parties in negotiating and entering into these transactions. What's your perspective on that in the coming years?
Well, I do think there's a political element to it. And I agree with what Jesse said. I think that the prior administration was more open, seemingly more open to certainly crypto space, but the bank fintech partnership space, a lot of the huge amount of growth that we experienced in those partnerships occurred coming out of that administration. And then the pandemic led to a lot of those partnerships as well. I will say, though, I'm not tying the future of these partnerships to the current administration. I think that these partnerships are the future, and the future is not going to be denied. And I really think that we're already on the downside of the slope here. There were a lot of partnerships that were put in place, just a tremendous amount of volume. There were a lot of participants that were getting into that space. And to be quite honest with you, I don't know that I blame it on guidance as much as I blame it on a lack of guidance as I blame it on just poor operators. And I think that what you've seen is, regulators, I mean, we saw this in the prepaid space 20 years ago. The regulators are going to come in as they learn about a new industry or a space. They're going to come in, they're going to criticize it. There's going to be a spike in enforcement actions, especially on smaller banks. And I think that we've seen that. And I think if you just look at the trend over the last 3 or 4 months, that trend has gone down dramatically. And so I think that there are certainly still bad partnerships out there that will be identified, or bad operators that will be identified. But I think that we are already moving into an environment where there's going to be less scrutiny of these bank partnerships, and the regulators are accepting the reality that this is the way that banking is going to be put together in the future.
All right, thanks. So we've left one relatively large enchilada for the very end of our discussion, and that's the states. And let me just give a little preface to this, Stephen, before I launch you to discuss it.
Sure.
First of all, so many of the issues that we've been talking about throughout the podcast thus far are areas of special state interest, like, for example, partnerships where states have been active in making true lender arguments, or recharacterization of non-credit products as credit. There are a number of states who've really taken the lead in doing that, with California being a great example of it. And on top of that sort of already existing state interest on a lot of issues that the industry will be interested in during the next 4 years, there is, of course, the high likelihood that if the states perceive lax federal enforcement of consumer protection laws, they will promise to fill the gap. And that's where, of course, our state AG practice comes in. And Troutman Pepper has what I believe is the preeminent practice in that area in the country. It was one of my primary motivations for us to come to Troutman almost 3 years ago now. And so I'm very fortunate, and I feel like our clients are very fortunate to have someone like Stephen and his team to be incredibly informed about what's going on with the states and assist with issues that will arise with regulatory investigations and other issues with the states. So, Stephen, do you mind telling the audience about your perspective on what the action will be like with the states in the coming 4 years?
Sure. Thanks for teeing that up, Chris. And I think this entire conversation has really led to this point, which is the role of the states in stepping in as gap fillers. And we saw that in the last Trump administration, and I think we are poised to see that again as the second Trump administration begins. And this isn't even a matter of having to dust off a playbook. They've been running this playbook for as long as I've been practicing, really for a couple decades. But the AGs have already been active and are active in investigating partnerships, in looking into, or we've seen them look into rent to own, buy now, pay later, all of the different areas that we've been talking about. Earned wage access is a huge focus right now. And the Democratic AGs in particular see themselves and see their role as being one of stepping in, stepping up when federal regulators pull back in the case of a Republican administration. And they will perceive any change in the level of scrutiny being applied at the federal level by the agencies as being something that they really need to step in and fill the gap on. So I think we will see that happening, and they've already got the playbook. They know how to run the plays. We will see them running them as soon as we start to see any sort of pullback on the regulatory side at the federal level. We often think of our strategies when it comes to dealing with state AGs in two ways, an offensive and a defensive strategy. And I think this is something that really fits into some of the opportunities that James in particular was talking about, where, we're going to see, I think, a real explosion in new products, in products that are really cutting edge, in partnerships. And what that will mean is that the companies that are engaging in those need to really think about how they are interacting with the regulators who are going to be most active in this new coming administration. And that's where the offensive strategy plays in. Companies need to think about how to engage with the AGs and explain to those regulators who are going to be the ones who are really at the forefront of regulation in this area why the products they have and are offering are compliant with the law, why they don't create consumer concerns, and why their products are really the gold standard. And that's something that we work with the different AG associations all the time and helping have those conversations, really educating the attorneys general about some of these products that the AGs are really just beginning to hear about or think through whether whether they fit into any of their older frameworks. So having an offensive strategy to really engage, whether that's at the Republican AG Association, Democratic AG Association, Attorney General Alliance, or the National Association of Attorneys General, lots of different venues to have those conversations. But I think that's going to be really important for the businesses that are thinking about What innovative things can we bring to market today? So that's the offensive strategy. And then, of course, you've got to have a defensive strategy as well, which is dealing with the investigations when they come, as we know they do, and as we know they will. And as you know, we're working on multiple AG investigations right now for clients in the fintech and financial services space, as I am with many others on your team, Chris. And I agree. I think the partnership that we've been able to build with you coming in to Troutman and really working so closely hand in hand with us and the state AG team has allowed us to bring your subject matter expertise and our venue expertise, put those together into something that I think is really powerful for our clients.
Yeah, thanks, Stephen. And it's a wonderful partnership, and it's one that I love telling clients about. So thank you for doing that. The other thing that I'd want to point out to our audience about states is that those same states that tend to have very active AGs also have shown themselves very willing and very able to pass legislation affecting the financial services industry. There are certain states like California, New York, Illinois, places like that have been steadily legislating on areas involving our industry, either directly for things like credit reporting or consumer credit protection or debt collection or things like that, or indirectly in more general statutes that will also affect our industry, like privacy statutes, for example, or Colorado being the first one to enact an AI statute, which of course will be impactful to the financial services industry. So I think the financial services industry also needs, during the coming 4 years, to be aware of those state legislative activities, to have an active government relations sort of presence and awareness so that they don't get blindsided by state legislation that might disrupt one of their business models, for example. And so that's probably the last thing that I'd want to mention about the states.
I'd add one more. We haven't spent a lot of time talking about the state banking regulators.
Sure. Go ahead, Jesse.
There are several of them who we know will also fill in that same void that we were just talking about the AGs filling. There are several state banking regulators that are taking certainly more aggressive approaches when it comes to TrueLender, certainly more aggressive approaches when it comes to EWA. So I think that we can expect there will be a hand in glove between the state AGs and the state banking regulators as well. So the wave will continue to crash. Like I said, I just think there will be different subjects. There will be different players. You still have to be prepared for it to come.
Yeah, and I would even add to that, Jesse. I mean, there's one particular state banking regulator that I'm aware of that has had a very high emphasis on fair lending in its examinations, even over the last 4 years, even when the federal government was very active in that area. And so we wouldn't expect that to die down.
The one thing that's been fascinating, having been a state regulator myself, a federal regulator, in-house, outside counsel, it's always fascinating that so much of state regulation, state banking regulation, is literally driven by one or two people who just have a passion for a particular issue, and they can bring a number of states along. And you mentioned a state with fair lending. A few years ago, there were a couple of states that were really on lead gen. If you go look at it, there's just a couple of people, and they're still there. I don't know what their issues du jour are, but they are still there, and they still have the power of the state behind them. So it's always the issues change. So some of our clients they're going to welcome this change. Other of our clients, they're going to find more scrutiny. So it's one of these things where you have to be careful what you wish for.
Yeah, exactly. Well, this has been a fascinating discussion, and I thank all of you for joining me on the podcast today. And of course, thanks to our audience for listening in today as well. Don't forget to visit and subscribe to our blogs, troutmanpepperfinancialservices.com and consumerfinancialserviceslawmonitor.com. And while you're at it, why not visit us on the web at troutman.com and add yourself to our Consumer Financial Services email list. That way we can send you copies of the alerts and advisories we send out, as well as invitations to our industry-only webinars that we hold from time to time. And as I mentioned earlier in the show, check out our handy mobile app. Just search for Troutman Pepper in your app store and give it a try. And of course, stay tuned every Thursday afternoon for a great new episode of this podcast. Thank you all for listening.
Copyright Troutman Pepper Hamilton Sanders, LLP. These recorded materials are designed for educational purposes only. This podcast is not legal advice and does not create an attorney-client relationship. The views and opinions expressed in this podcast are solely those of the individual participants. Troutman Pepper does not make any representations or warranties, express or implied, regarding the contents of this podcast. Information on previous case results does not guarantee a similar future result. Users of this podcast may save and use the podcast only for personal or other non-commercial educational purposes. No other use, including, without limitation, reproduction, retransmission, or editing of this podcast may be made without the prior written permission of Troutman Pepper. If you have any questions, please contact us at troutman.com.